Ladies and gentlemen, welcome to the Red Leaf podcast. It's my absolute pleasure. A little bit of a change around. I'm lucky enough to be in the nice offices of WT Financial. Now, if you want to know about a company that has a small market capitalization, 48 mil, and actually pays you a dividend and how they did it, this is the man to speak to, Keith. Keith, how are you?
Yeah, fantastic. Appreciate this opportunity.
Mate, thank you for having me in your lovely premises. Now, a bit of background for the punters out there that don't know, and before I start, obviously, this is not financial advice. Speak to your financial advisor. And now let's get into it. Tell us about the past. You were quite successful in going against the grain when you started WT Group.
Yeah, that's true. Initially, when we listed the business, we were a direct-to-consumer business. So I think this is one of the differentiators between ourselves and other financial services licensees out there, is everyone in this business has got a really solid background in providing advice direct to consumers ourselves. So we started the business back in 2010, and up until 2017 and 18, we built from a zero start, really, into a very large financial advice business. We had integrated tax and accounting, mortgage broking, estate planning, and of course the lead, which was financial advice. So all of those other things we really did as a subset of being advisors. And in 2017 and 18, those that follow the sector will remember the Royal Commission. And we looked at it and went, you know what, I think we're going to see a significant unravelling of the vertically integrated model. We think we're going to see everyone running for the exit from the space, yet we believe that demand for financial advice is going to continue to grow. So if you take people out of the market, if you reduce advisor numbers, yet demand keeps growing, we said, let's be counter-cyclical about this. And I think my chairman put it at the time. He said, so what's your proposition, Keith? We're going to exit the retail. And we did that by selling assets to provide us some capital. We raised more capital. And we did, as my chairman called, we ran into the burning building that everybody else was fleeing. And it was a pretty bold move at the time because we didn't have a lot of love and attention focused on the sector, but it's really starting to pay dividends, quite literally, for our shareholders now.
We'll get to the dividends first. Yearly results, which were very, very impressive. Can you tell the audience the key highlights and the most impressive part?
Well, I guess before I get to the actual numbers, is really the most impressive part for me is what we've been able to achieve operationally and within these networks that we've brought together, which has enabled us to deliver on those results. So if we go back to when we made this decision to sort of exit direct to retail and move into what we'd call a business to business space, is from 2018 through until now, we've made 4 key acquisitions. We started with the acquisition of a small group of advisors called Wealth Today, and that was in 2018. In 2020, we made another acquisition of a group called Century Group. Then 2022, Synchron Group, and 2023, Millennium 3. So we've brought together 4 really disparate businesses with a really broad variety of advisors and underlying clients in those businesses. We've maintained the brands because they've got great sort of legacy attached to them. And a lot of the advisors in there have been with those brands for, 5, 10, 15, 20 years. But what we've done is we've restructured everything in terms of the way we provide services and the way we support those advice practices to bring it under one common banner on the back end, if you like. And that's enabled us to do 2 things: get really efficient and broaden the range of services we're providing to all of the advisors and their underlying clients, and also obviously to get the operational efficiencies in terms of doing it in a really cost-effective manner. And that's seen us sort of take these 4 businesses that were sort of breaking even, just making a little bit of money, consolidate them into a single business and start to deliver great profits. As far as the half year is concerned, looking back from the prior corresponding period, I think revenue was up about 35%, net profit before tax up by nearly 40% on the prior corresponding period. What's driven that has been us being able to maintain costs as we brought these businesses together, or reduce costs and take costs out of the business, and also continue to drive revenue. And the important part about us driving revenue in this business is you'll see us have a big revenue number. I mean, I think
Mhm.
we're $110 million for the half year or something. That's because our revenue number includes all of the revenue that the advisors are charging their clients and all of the revenue that they're collecting on insurance commissions and so on. Now, we share in that revenue with them,
Mhm.
but we're also earning fees in terms of base fees from the practices for the supports that we provide them and so on. So our gross revenue number looks really high. We don't report on, and the reason we report all of that revenue, all the advisor revenue, is from a statutory perspective, we own that revenue because we own the liability for it. We're responsible for the conduct of our advisors. We collect all of that money. Some people in our space report on net revenue. I suppose if you look at our EBIT line or our net profit line based on our revenue, it looks like we're on pretty thin margins. If you look at it against our net revenue, we're looking at an EBIT margin. Our net revenue on our sort of 110 million is probably around $11 million, $12 million. So when you look at the EBIT margin, starts to look a lot better, close to $3 million on that 11. So
They are very impressive numbers. Now, as an investor, without influencing anyone out there, I think it's extremely undervalued. Do you think your business is undervalued because everyone's kind of negative in the financial services space?
Yeah, look, I think there's two things, and I'll be fair, I haven't griped a heck of a lot about how undervalued we've been in the last few years because I was confident that we had. Look, this is a board and management-led business. Board and management have got about 30% of this business. So it's a founder-led business, and we've got some really strong institutional shareholders in the business who backed the vision and understood the vision. But I understand when you're in the micro cap space, is it's easy to look at things and go, well, look, these guys have pivoted from retail to wholesale or B2B. They're making acquisitions. There's execution risk. I think these are all the reasons. And not only that, the sector was on the nose after the Royal Commission. Everybody ignored it. So I can completely understand why people weren't paying attention to the sector, and those that were paying attention to the sector were probably thinking, well, let's see how Keith and the team go in terms of their execution. What I'd say to you is I think that execution risk is gone now.
Yep.
We've really delivered. The team has proven that they've been able to bring together these assets, operate them efficiently, deliver the services to the advisors, and in doing so, drive our revenue and their revenue and profitability. And obviously, now we're returned to dividends. We weren't paying a dividend also, obviously, because we're on that acquisition path. Our full year result last year, we returned to dividends. We said that as and when cash flow permits, as our policy is to pay twice yearly. So, we paid a 0.5 dividend on the full year result when we returned to dividends. We're indicating a sort of 0.2 dividend this year, or for this half, sorry. Undervalued, I think we are still. I mean, the stock price has responded well. We're sort of gone from that sort of 7, 8, 9 cent mark to now sort of 12.5, 13.5, 14 cents we touched yesterday. I haven't had a look this morning. I think still at those numbers we're undervalued. If you just look at our full year result for last year, I think we're still only trading at around a sort of 11 to 12 PE. Against our sector, which is around 13.5. And, given that we've got this strong growth profile, I think it's a pretty good time to have a look at the sector more broadly, but definitely have a look at WTL.
So you mentioned dividends and capital allocation. You've grown via acquisition. Now we could pay dividends. Where's the growth now for the business? Are we growing organically? Do we have more space for a bigger dividend? Where are we going now?
Yeah, look, I guess the first thing I say to shareholders when we talk about the issue of dividends is that there's nobody more motivated than sort of management board and the founder in terms of dividends. So our interests are really well aligned. I mean, I think we've got, I think one of the issues when you look at micro caps in particular, if founders hold sort of 50, 60, 70% of the businesses, you start to worry about, the interest all with the founder. I think within our business, with it sort of being around that 30% mark and us having good institutional shareholding, it's a really nice balance, and so interests get balanced. in terms of driving profits further, to a large extent, I feel like we're just at the starting gate, right? We brought all these businesses together. We've proven the investment thesis. We've shown that we can execute. A really important thing about our business is that we share in revenue with our advisors. And what's key about that is our investment thesis all along was that advisor numbers are down. You know, if you go back to pre-Royal Commission, there was more than 25,000 licensed advisors in Australia. We're now sitting at 15,500 on the register. There's a trickle of new advisors coming in that is barely letting us hold water in terms of replacing those that are retiring. And so there's this restriction of supply, a supply-demand imbalance, and there's a chokehold on supply, which is at a time when demand is through the roof. We've got an estimated 2.5 million people retiring, going from what would be accumulation mode in their superannuation through to pension mode in their superannuation over the next 10 years. Super assets are now well more than $4 trillion. The net growth of super assets is about $2.5 billion a week at the moment. I mean, these are phenomenal numbers. There's a wall of people and a wall of capital coming into retirement, which is the primary time that people seek advice. Not the only time. You know, there's a lot of wealth creators in the market and so on, but it's the primary time and where the highest impact that advisors can have is in that run up to retirement and as you step through to retirement. So it's where consumers place the most value and are prepared to pay the most fees and have the capacity to pay the most fees. So all of the fundamentals are right for the profession. We're really working with our practices to maximise their revenue by making sure they've got their fees set right, not gouging people, but just making sure that they've been properly rewarded for the professional qualifications they've got, for the impact that they can have, and for the risks that they take, quite frankly. Because, you know, once we give advice in this profession, we own that advice. You know that.
Exactly.
There's no getting rid of that liability once you've given it. So all of that's got to be properly rewarded. But the good news is there's more than enough clients out there with more than enough capital and capacity to pay for everyone to really grow their revenue per advisor. And so the next step is to then grow the number of clients per advisor through innovating with technology. And the good thing about this, with the way that we have our relationships set with our advisors, with our practices, we're completely aligned. If we help them with all of these things, we can afford to invest in helping them with technology, helping them with marketing, helping them with their pricing strategies, because as and when we do that and their revenue grows, unlike some other advice networks out there that are on a fixed fee with their advisors, we've got that variable component. So we're really motivated to help them grow. I think that'll really grow us considerably. And then the next thing is, I think we're going to see a lot of M&A activity within the underlying advice practices as well.
So going back to the demand and supply, there's clearly demand there. There's reduced supply, which is very beneficial to the financial services sector. However, do you think there's serious cost pressures, and such as people moving to ETFs, for example, because it's cheaper, managing their finances themselves, because they simply, in a cost of living crisis, they just simply don't want to pay for that advice? How do we get around that?
Yeah, look, I think for the moment and for the most part, that's the fact that a lot of people can't afford advice or don't want to pay for advice is not really a factor for the profession. The reality of it's this: there's 15,500 of us, and even when there were 25,000 of us, that's going nowhere near being able to service the enormous demand that there is there. So I'd say to you that it's been really interesting. We had the previous government introduced what they called the Quality of Advice Review, and they had a lawyer by the name of Michelle Levy sort of review the market and look at this issue of the affordability and access to advice in Australia. But there's two separate issues with it that often people conflate. There's affordability and access to proper professional holistic advice, where somebody is really having a big impact and spending a lot of time with their client. And there's one solution to that, to make it more affordable and more accessible. That's to fix what the current education standards are on advisors. Because in the wake of the Royal Commission, we had this governmental body that had been spun up called FASEA, and It was loaded with a whole bunch of well-meaning academics, but they were charged with the responsibility of saying, to increase advisor education standards, what should constitute a relevant degree? And instead of saying, well, a relevant degree should be finance, economics, accounting, commerce, all the things that you think would make sense, they said, oh, a relevant degree needs to be this very esoteric financial advice degree. Well, guess what? Nobody's doing it. And so not only did we have sort of 10,000 advisors exit the profession, it's when they're 17 and 18, they don't know enough about what they want to do with their future to commit to a 4-year degree that is as esoteric as financial advising. Now, those that have been doing it, most of them have a relative that's in the profession already. You know, they're an advisor's niece or nephew or sibling, etc. But it's not just the young advisors. What it put a chokehold on was career changes. So, you know, you could have been a portfolio manager at a fund manager for 10 years with a finance and economics degree. You could have been an accountant with a successful practice for 10 years, back to school for 2 years before you can even make the bridge across. So if we want to fix the affordability of advice, now you might say I'm arguing against myself here because what's really driving the profession at the moment is the supply-demand imbalance. But we want to see it fixed because we all want to be able to grow our practices as well. So I think that'll be really positive, and it'll definitely bring prices down because that's what happens with supply-demand. But we'll be serving more people, and technology will let us serve more people as well. So I think we've got a really big future in that. And the good news on that front is we've been lobbying hard to see what constitutes a relevant degree changed to get back to what we all thought it was going to be, which was finance, economics, etc. Just Monday this week, Stephen Jones, the outgoing Minister for Financial Services, announced the government's policy now is to fix that, to return it to what was supposed to be, which is any sort of business degree like finance and economics and so on will give you 4 units, and then you can start a professional year and top that up with 4 vocational units as well. That's a monumental win. The coalition's in opposition, but they've come out and said we absolutely support that. So we think whoever wins this next election, we're going to get that fixed, and that's a great opportunity. In terms of servicing what you'd call the lower value or the self-serve clients, the quality of advice review of advisor that, if you like, in old terms, we'll be able to give what would have been known as general advice, which is stopping short of a recommendation. So not sort of putting their neck on the line, but giving consumers enough information to be able to make an informed decision of their own. Now, you know, general advice exists currently, but as soon as you know too much about the client, it's considered to be personal advice. So that's the important change that legislation will make. You can know as much as you like about the client, as long as you stick to the facts and options, and as long as you don't make a recommendation, it'll be deemed to be able to be given by that. And we think that's really important. You know, there's a whole class of people that want to just ring their super fund up or ring their insurer up and get some help. They're not really our target market, but also it will enable practices to hire young people to start serving those sort of episodic and one-off pieces of advice just with information while they're doing their training to become full-blown advisors. So we think that sort of reform is really positive for both consumers and the profession more broadly.
So now looking forward, what do shareholders have to look forward to over the next 6 months or year?
Well, I think we're going to keep trying to drive that top line to grow the underlying practices, which that growth comes through to our bottom line as well. And then what we've seen increasingly, look, we provide a really broad range of services to our advisors. You know, we're not this low-cost financial services license that people just rent their license from, as we commit an enormous amount of time and energy to training and educating our advisors. That's why we have this studio that you've been good enough to come here and conduct this from. And we really focus on practical application with that, helping them grow their businesses. We help them with practice management, organising their businesses, getting them more efficient so that when they're implementing advice for clients, as they're keeping their costs under control. And we help them a lot with their business planning. And increasingly what we're seeing from them is they're saying to us, can you help us with M&A? because we want to build more scale. Whilst those reforms of being able to hire people from outside the profession are coming, they will take time, they will take legislative change. In the meantime, advisors are saying one or two things. I want to grow and be efficient on the back end. Can you help me merge with people? Can you help me acquire my neighbour? And some of the advisors are going, listen, Keith, I'm 62. I've got 3 years to retirement. I want to maximise my opportunity. Can you help me come together with someone? So we've seen an enormous amount of offshore capital being attracted to the Australian market, wanting to invest in underlying advice practices. The reason for that is that supply-demand imbalance. People internationally are seeing the opportunity, and secondarily, the valuations here are a lot lower than what they are in the US, for example. So if you want to invest in wealth management, invest in the US and you're paying multiples of 12, 15, sometimes higher EBIT. Here in Australia, it's more like sort of 5, 6 or 8. So that capital's been attracted because of the size of the super pool here and the baked-in growth in the market. And so advisors are saying to us, how do you help us access capital, debt? Can you help us access capital and debt? So increasingly, we're seeing that demand from advisors, and we see that as being a great revenue opportunity for ourselves within the business as well, as to give them those sorts of advisory services. Because if you're looking for an experienced team that know a lot about both equity and debt markets and M&A in financial services, well, the team here's got an incredible amount of experience in that, both from our retail experience and the acquisitions, the M&A that we've done in the B2B space. So we see that as a big opportunity also.
Keith, thanks for having me, especially in your lovely studio here. Ladies and gentlemen, definitely have a look at this company. The ticker is WTL, WT Financial. Worth having a look. One of the few small cap stocks that actually pays you a dividend. Thanks for having me.
Thanks very much.
Cheers.